Here's a mistake that wrecks more beginner accounts than any single indicator: trading against the trend. Today you're getting the two tools that tell you which way the market actually wants to go, and exactly when to pull the trigger. Welcome back to Aurea Trader Academy. This is Lesson 2, Trends and Reversals, where we bring in our first two real indicators, the EMA 50 and the stochastic oscillator. Let's get into it. By the end of this lesson you'll know four things: what a trend actually is, uptrend, downtrend, and sideways, and why sideways is the one to avoid. How to read the EMA 50 as your trend filter at a glance. How to read the stochastic oscillator to spot overbought, oversold, and momentum turns. And how to combine both into one simple rule, because timing tools alone fail without a trend filter behind them. Price only ever moves in one of three states. An uptrend, higher highs and higher lows, climbing in steps. A downtrend, lower highs and lower lows, falling in steps. And sideways, no clear direction, just chopping in a range. Here's the goal for this whole lesson: only trade the two directional states, and use our tools to confirm which one you're actually in. You're getting two tools today, and they do different jobs. The EMA 50 is your trend filter, a single moving average line that tells you the direction price is favoring right now, up, down, or unclear. It answers what's the bias. The stochastic is your timing tool, a momentum oscillator that tells you when a move looks stretched and due for a pause or a turn. It answers, is now a good moment? Neither one works well by itself. That's the whole point of this lesson. EMA stands for exponential moving average, the average closing price over the last 50 candles, weighted so recent price action counts more. It smooths out the noise of individual candles into one flowing line, so you can see direction at a glance instead of guessing from a jumpy chart. And it plots directly on your price chart, no separate window needed. Notice on this chart, price riding above a rising EMA 50 means an uptrend bias. Reading it only takes three simple checks, no calculation required. Price above a rising EMA 50, uptrend bias, favor call setups. Price below a falling EMA 50, downtrend bias, favor put setups. And price weaving back and forth across a flat EMA 50, no clear trend, the safest move is to just sit out. The stochastic compares the current closing price to its recent trading range, then plots the result on a 0 to 100 scale in a window below your chart. The standard setting is 14-3-3, a 14-period lookback, smoothed into two lines, %K, the fast line, and %D, the slow signal line. High readings mean price is closing near the top of its recent range. Low readings mean it's closing near the bottom. Three readings are worth watching for. Overbought above 80 means price has closed near the top of its range repeatedly, so a bounce or pause becomes more likely. Oversold below 20 is the mirror image at the bottom. And a %K/%D cross, where the fast line crosses the slow line, signals a shift in short-term momentum. Now here's the trap that catches almost every beginner. In a strong trend, the stochastic can sit in overbought or oversold territory for a long stretch, not because a reversal is coming, but simply because the trend is powerful. Trading every overbought or oversold reading as a reversal signal means fighting a strong trend and losing repeatedly. The fix: never trade the stochastic in isolation. Filter every signal through the EMA 50 first. Here's the actual rule that ties both tools together. For a call setup, price is above a rising EMA 50, the stochastic drops below 20 into oversold, and %K crosses back above %D, both turning up. All three align? Consider a call. For a put setup, it's the mirror image, price below a falling EMA 50, stochastic rises above 80 into overbought, and %K crosses back below %D, both turning down. Let's walk through a real example. Pound sterling to US dollar is in an established uptrend. Step 1, check the EMA 50, price is trading above a rising EMA 50, uptrend bias confirmed. Step 2, watch the stochastic, it dips to 14 as price pulls back, oversold territory. Step 3. Wait for the cross. %K crosses back above %D, both curling upward past 20. Step 4. Confirm with price. A bullish candle closes back above the pullback low. Step 5. Enter the call. Notice, no single tool triggered this trade. All three had to agree first. One of the hardest skills here is telling a pullback from a real reversal, because in the first few candles they can look identical. A trend continuation pullback, price dips toward the EMA 50 but holds above it, the stochastic touches oversold and turns back up quickly, and the trend resumes. This is the setup you want. A genuine reversal, price closes clearly through the EMA 50 on strong candles, the EMA itself starts to flatten or bend, and the stochastic confirms with a full cross. Treat the old trend as over, and wait for a fresh setup. One bonus concept worth knowing once the basics feel automatic: divergence. Bearish divergence is when price prints a higher high, but the stochastic prints a lower high. Momentum is fading even as price pushes up, a warning the trend may be tiring. Bullish divergence is the mirror, a lower low in price, but a higher low on the stochastic. Treat divergence as a caution flag, not a standalone signal. You still want the EMA 50 and a stochastic cross to confirm. Here's where this setup goes wrong for beginners. Trading against the EMA 50, taking a put while price sits above a rising EMA 50, or vice versa. Chasing overbought or oversold readings in a strong trend, ignoring the trap we just covered. Skipping price confirmation, entering on the stochastic cross alone, before a candle actually confirms the turn. And trading a flat EMA 50, taking directional trades when price is just chopping sideways around it. 5 lines to remember. The EMA 50 sets your bias. Above a rising EMA favors calls, below a falling EMA favors puts. The stochastic times entries, watch for overbought above 80 and oversold below 20, with a %K/%D cross. Never trade the stochastic alone. Strong trends can stay overbought or oversold for a long time. Only take stochastic reversal signals that agree with the EMA 50 direction. And wait for a confirming candle before entering. Alignment alone isn't a trigger. Up next in the Academy, the candles you've been staring at this entire video, finally explained on their own. Lesson 3 is candlestick basics, candle anatomy, bullish versus bearish, and the key patterns like doji, engulfing, and hammer. Before you go, test what you just learned. There's a free 10-question quiz with an answer key linked in the description. If the EMA 50 and stochastic combo just clicked for you, that's genuinely one of the most useful setups in this entire course. Hit subscribe so you don't miss lesson 3, drop your questions in the comments, and I'll see you there.